Stop whatever you are doing this very second. Yes, absolutely everything. If your finger was about to tap another link, if you were glancing at your phone or even mentally planning your next move, stop, freeze. Because what you're about to hear is not some wild conspiracy, not a fortune teller's market prediction, and not meaningless financial chatter. What I have in my hands is something far more serious. It is a ghost, an internal document that was never meant to be seen by the public. This is a confidential, high-level directive issued from deep inside one of the most powerful investment banks on earth. A memo straight from the heart of the system. The bank is Morgan Stanley. More precisely, this message came from their commodity trading desk, the core command center where billions of dollars are shifted in mere seconds. This memo was circulated just 72 hours ago. It was delivered exclusively to Morgan Stanley's most elite clients, hedge funds, sovereign wealth funds, and ultra-high net worth individuals who sit at the very top of the financial food chain, the 1% of the 1%. And inside this memo are 3 words that should instantly send a chill through your spine. Exit all positions. Pause for a moment and think about that wording. In high finance, language is chosen with surgical precision. They did not say reduce risk. They did not say rebalance exposure. They did not say hedge for volatility. They said exit. On Wall Street, exit is not advice. It is an evacuation order. It is the command issued when a situation is beyond repair. It is what you hear when the ship is sinking and the hull is already tearing apart. It is what you hear when a building is burning and the supports are about to collapse. Morgan Stanley, a financial titan overseeing roughly $3 trillion in client assets, is instructing its clients to abandon the silver market completely. Not eventually, not gradually, completely. And they have imposed a hard deadline, the end of this month. This is not guidance. This is panic at an institutional level. This is the sharpest minds in finance realizing they are sitting on an explosive device, and they have calculated that they have only days, not weeks or months, to escape the blast zone before everything detonates. I have personally seen this memo. I have confirmed its authenticity through multiple sources embedded deep within the institutional trading world. What I'm about to explain to you may be the most important piece of financial intelligence you hear this year, possibly this decade. When a bank like Morgan Stanley runs, it means their proprietary risk models are screaming. It means they see something coming that the public cannot see. It means a disaster is approaching, one that will permanently reshape the precious metals market and create a brutal divide between those who understood the warning and those left standing in the wreckage. Right now, you have a decision to make. You can dismiss this as hype, sensationalism, or another boy who cried wolf story. Or you can recognize what this really is, the financial equivalent of watching rats flee a sinking ship. Smart money always knows first. They always plan the exit before the first wave hits the deck. So let me show you exactly what Morgan Stanley sees. Let me show you why they are running. And most importantly, let me show you what must be done before this evacuation becomes public knowledge and every exit is blocked. The memo itself is shockingly short, just 3 paragraphs, but every sentence is a precision strike. When you are instructing billion-dollar clients to dump positions, you don't waste words. Paragraph 1 identifies the trigger. It states that due to extraordinary volatility and, this is the crucial phrase, structural changes in the silver derivatives market, Morgan Stanley is advising all institutional clients to close every single long and short position in COMEX silver futures, options on futures, and over-the-counter silver swaps. Structural changes is Wall Street code for one thing. The system is broken. When a market's structure changes, the rules that once held it together no longer apply. It's like discovering that the bridge you cross daily has developed invisible fractures, and engineers can no longer guarantee it can support even one car. You don't drive slower. You don't reduce the load, you shut the bridge down. Paragraph 2 introduces urgency. It states that this instruction applies to all position sizes and all expiration dates. But then comes the most alarming line of all. Clients are instructed to prioritize orderly liquidation over price optimization. Translated into plain language, we don't care if you lose money. We don't care if you sell at awful prices. Just get out, now. Sell into whatever liquidity still exists, because whatever is coming at month end is far worse than any loss you take today. That deadline is not random. It represents a mathematical wall. Morgan Stanley knows a convergence event is approaching, one that will make holding silver positions extraordinarily dangerous. Paragraph 3 is the nuclear admission. Morgan Stanley states it will reduce its own proprietary silver exposure to 0 over the same time frame, and will accept no new silver-related business until further notice. Think about that. A global bank exists to generate fees. Every trade is income. When a bank refuses new business, it is deliberately setting fire to its own revenue. Banks only do that when the risk becomes existential. Morgan Stanley has concluded that the silver desk is no longer worth the danger of it potentially taking down the entire institution. To understand how serious this is, you must understand how a memo like this comes into existence. Banks do not casually frighten their clients. Every word is vetted by lawyers, compliance teams, and risk committees. It likely reached the executive level. Telling clients to exit positions creates massive legal exposure. If the bank is wrong, lawsuits follow. Reputations die. Clients leave. The fact that Morgan Stanley put this in writing tells you everything. Their internal models are screaming louder than the legal risks. They have calculated that the danger of silence is greater than the danger of warning clients. Their conclusion is clear. There is a high probability of a catastrophic silver market event before month end. So what do they see that you don't? Morgan Stanley's commodity desk has near omniscient visibility. They see real-time institutional order flow. They see what JP Morgan, Goldman Sachs, and Citi are doing behind closed doors. They track physical metal movement across the globe because they are part of the supply chain. And right now, every screen is flashing red. They see 3 crises colliding simultaneously. Crisis 1. Inventory. Collapse comics. Registered silver has dropped below 32 million ounces, the lowest level in over a decade. 6 weeks ago, it was 41 million. That's a loss of 9 million ounces, about 1.5 million ounces per week. Recently, the decline accelerated. 4 million ounces vanished in just 14 days. At this pace, registered inventory could hit 0 in 8 weeks or less. Yes, skeptics point to the 230 million ounces in eligible inventory. But eligible silver is privately owned. It does not belong to the exchange. With physical premiums exploding globally, those owners have zero incentive to sell. Eligible silver is frozen. Registered silver is the only buffer, and it is evaporating. Crisis 2. Delivery demand explosion. Silver is a paper market. For every real ounce, hundreds of paper ounces trade. Historically, only about 5% of traders demand delivery. Last cycle, 9% stood for delivery. Next cycle estimates, 12 to 15%. There are roughly 160,000 open contracts, representing 800 million ounces. If 15% demand delivery, that's 120 million ounces required, against 32 million available. That is a mathematical impossibility. The result? Default, force majeure, cash settlement. And the moment that happens, paper silver is exposed as fiction. Crisis. 3. Counterparty risk. Beyond exchanges lies a shadow market with 5 to 10 billion ounces of notional silver exposure. Many players are massively short metal they don't own. As physical prices disconnect, shorts bleed. Morgan Stanley sees banks scrambling for collateral and drawing emergency credit. One failure triggers contagion. Dominoes fall fast. Morgan Stanley sees the first domino wobbling, and they want no part of the collapse. These crises feed each other into a doom loop. Falling inventories cause fear. Fear drives delivery demand. Delivery drains vaults faster. Shorts panic and buy, pushing prices higher. Rising prices attract more buyers. Physical premiums explode. Paper markets lose credibility. The loop accelerates exponentially. Morgan Stanley's models show we are already in that acceleration phase. Their timeline shows the escape window closes at month end. They've seen this movie before. 1980, Hunt Brothers. Rules changed, long sacrificed. 2008, first mover survived, Lehman didn't. 2022, nickel market. Trades canceled to save insiders. Morgan Stanley learned the lesson. When systemic risk appears, you don't wait to be right. You get out. That's why they warned clients. Legal cover and controlled retreat. They need time to unwind without detonating the market instantly. Retail investors see $30 silver and think everything is normal. Meanwhile, the giants are already halfway out the door. When Morgan Stanley fully exits, volatility will turn violent. Shorts buying will spike prices. Long liquidations will crash them. Stops will cascade. Spreads will explode. $27 bids against $30 asks. When the biggest player stops caring about price, market structure collapses. And that is exactly what Morgan Stanley is preparing for. This is what is known as a liquidity death spiral. And we are not talking about years away. We are talking about mere weeks. As the month draws closer to its end, you are about to witness something called the Great Divergence. Under normal conditions, paper silver prices and physical silver prices move together step by step. But when a system begins to collapse, that relationship fractures completely. Institutions start dumping paper exposure, and as a result, you may actually see the official spot price of silver fall. At the exact same time, the price of an actual physical silver coin may remain unchanged, or even rise sharply. Why does this happen? Because the people who already hold physical metal will see the disorder unfolding and will simply refuse to sell. This creates a surreal scenario where the official price might say $30 an ounce, but when you walk into a dealer, they demand $50. That gap is the signal that the market is broken. This is precisely why Morgan Stanley is instructing its clients to exit everything. They understand that the price is about to turn into an illusion. If you are holding a paper contract, what you really own is a promise, and that promise may not be honored. So why is the end of this month such a hard red line inside a giant institution like Morgan Stanley? Because it represents a moment of complete and total exposure. On the final day of every month, banks are required to perform mark-to-market accounting. Every position on their books must be revalued at current market prices and officially recorded on their balance sheets. These balance sheets are then examined closely by the Federal Reserve and global regulators. If the bank is holding large silver positions that suddenly show devastating losses, it directly damages their capital ratios. And if those ratios fall too low, the bank risks credit rating downgrades, higher borrowing costs, and loss of institutional trust. By forcing all positions to be closed before month end, Morgan Stanley is executing a balance sheet purge. They want to be able to state clearly and legally, we have zero exposure to the silver crisis. This is also why they are pushing their clients out at the same time. If a major client collapses under margin debt, the bank often ends up absorbing that loss. By clearing the deck now, Morgan Stanley is shielding itself from the financial bloodbath they believe is approaching. At this very moment, you are living in what can be called the gap. This is the short period between when smart money becomes aware that disaster is coming and when the general public finally feels it. Look at today's financial headlines. What do you see? Analysts debating interest rates, commentators discussing employment numbers. Everything appears calm. This is the illusion of normality. But beneath that surface, billion-dollar blocks of silver contracts are being quietly unwound. Mainstream media will not report on this memo. Why? Because the people who control major media outlets are often the same entities attempting to exit their positions. They need you to stay invested. They need your money to remain in the system. You are the liquidity that allows them to sell without collapsing prices too soon. In every major financial crash in history, the public narrative is always the same. Everything is fine, until suddenly it isn't. Morgan Stanley is not waiting for headlines to change. They are acting on raw data. And that data says the orderly phase of this market has ended. So what should you do with this information? You need to stop thinking like a gambler and start thinking like a risk manager. Step 1. Identify your exposure. Review your portfolio carefully. Do you own silver? And more importantly, how do you own it? If your silver is held in an ETF or an unallocated account, then you are holding paper. In a structural market failure, paper instruments are the first to break. You could wake up one morning to discover that your silver ETF has been liquidated at a price dictated by the exchange, not the market. Step 2, understand the conversion window. You have approximately 3 weeks, possibly less, until the month ends. Your objective should be to convert as much paper exposure into physical possession as possible. Yes, you will pay a premium. Right now, that premium could be $10 above spot. Do not think like a retail shopper. Think like an institution. An institutional mindset says, I would rather pay $40 for something real than $30 for a paper claim that could become worthless. Step 3, watch the red line indicators. You must become your own analyst. Check the COMEX Vault inventory reports daily. If registered silver drops below 25 million ounces, you are officially in the danger zone. At that point, an exchange default becomes highly probable. Step 4, prepare for bipolar volatility. The paper silver price is going to behave like a dying star. When shorts are covered, prices will spike violently. Do not celebrate. When long positions are liquidated, prices will crash. Do not panic. If you hold physical silver, ignore the spot price entirely. The only price that matters is how much it would cost you to replace that silver if you sold it. There will be skeptics watching this who think banks exit positions all the time. They will say they have heard about a silver squeeze for years and nothing ever happens. That is the skeptic's trap. The belief that because something hasn't happened yet, it never will. But look around. We have already watched the nickel market break. We have seen regional banks fail. The silver market is small and massively leveraged. If Morgan Stanley's models are telling them to abandon a profitable business line, the math has crossed a critical threshold. Ask yourself this: what is the risk of being wrong by following their lead? If you buy physical silver and nothing happens, you still own a tangible asset. But if Morgan Stanley is right and you stay in paper, you could lose everything. The risk to reward calculation is obvious. When the smartest people in the room sprint for the exit, you don't argue, you move. Beyond this memo, there is a larger geopolitical pressure cooker building. For decades, Western financial systems suppressed silver prices through paper markets, but the rest of the world is no longer cooperating. In Asia, especially China and India, demand for physical silver is relentless. Traders are buying silver at artificially cheap paper prices in New York and shipping it east to sell at true market value. This is the vacuum-draining COMEX vaults. At the same time, silver has become a critical industrial metal. Solar energy, electric vehicles, advanced electronics, and modern weapon systems all require enormous quantities of silver. We are now operating in a global structural deficit. You can create infinite paper contracts, but you cannot print a single ounce of silver. Morgan Stanley is leaving because they refuse to be trapped inside a failed exchange. We are entering the final days of the old silver market. You will watch availability move from in stock to delayed to loss, sold out. This is the countdown phase. If you hold paper silver, a decision is in front of you. If you hold physical silver, you're already in the lifeboat. Do not let paper volatility scare you out. Those who endure this transition will be the ones holding real purchasing power in the new system. Morgan Stanley has effectively given you a 72-hour informational advantage over the public. Information is the line that separates winners from losers. The exit door is still open, but the crowd is beginning to move. Do not wait for the stampede. This is not a surprise. It is the documented and unavoidable end of a broken system. Morgan Stanley is out. Their clients are exiting. The only remaining question is not what they are doing. The question is, what are you going to do? The countdown has begun. Use your time carefully. When this month ends, the paper bridge will no longer exist, and the only thing that will matter is what you can physically hold in your hands. Exit all positions before it's too late.